Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, February 9th, 2021. In this video, what I want to do is start out very brief update on the broad markets. Nothing new to mention there other than what I pointed out this morning. We have some back tests on the index futures, S&P 500 futures, as well as the SPY. We have a breakdown in crude oil. I want to touch on that real quick. And then I want to follow up on some of the things I'm watching this week. I mentioned recently one of the things to keep an eye on, and again, this could take days or months to pan out, but it's the risk of inflation to the market. Everything I've covered that in detail, so I'm not going to go too much on that. Again, the fact that we've seen a huge surge in commodity prices, home prices, all the big components of the no, CPI, of course, and that's where I'm going with that. So what we're going to look at is the CPI is coming out tomorrow. So you have the CPI tomorrow, as well as Powell reporting. So we're going to talk on that real quick, and then also how to, if you want to lay a bet on that. I'm going to go over the Fed funds futures, give you a trade idea there. BRR, somebody asked yesterday, I saw it up, somebody wanted an update on Bitcoin. It's been a while, so I'll update that and some of the recent trade ideas. And then Treasury bonds. Okay, so throwing a lot out there. And again, so it's going to be kind of a mixed bag. Let's just jump into the charts here. S&P 500. Again, same thing, been saying for the last few days. Back test, back test, back test. We continue to back test the primary trend line after the breakdown on the S&P 500. The negative divergences are still very much intact. So no sell signal. Well, we had a sell signal when we broke down, but it was not confirmed. I said it clearly at the time. You have to see the NASDAQ 100 break. So this is, like I said, an objective but an aggressive entry. You could short it here. Same thing with the ES, the S&P 500 E-mini futures. This is a 60-minute chart, so you're looking at a different trend line, a shorter-term trend line, but one that's pretty well defined, lots of reactions along the way. Same story on the 60-minute time frame, divergent high. So what you had up to this point right here is a bearish rising wedge with negative divergence that had been building. You had a breakdown. There's that same sell signal on the S&P 500 or the SPY I just showed you. You back tested both the trend line and that 3818 resistance level. Rejection put in, as mentioned at the time, a little divergent low right there on the 60-minute chart. That's been the MO for months now, and usually isn't an uptrend. It doesn't take much, a very big divergent low to spark the next leg up, and that's what we had. Now, when you look at the bigger picture, that kickback rally has taken us to back test this trend line from below, and that's what I mentioned today. So I said it's an aggressive, objective yet aggressive entry. Why is it aggressive? Because it's very much a counter trend trade. However, it's easy, it's simple, and I like those kind of trades because the risk reward is very favorable. You have a stop not far above. If you take back the trend line, and the thing is you can back test it for a little while like we've been doing on the SPY daily. So your stop should be in line with what you're targeting. So if you're viewing this as it looks to me, a big rising wedge pattern, and you extend the trend lines, both the divergence line, that upper trend line, and the primary uptrend line there, we're back testing right at the apex of the wedge. And so if it were to play out, you can see the targets. We reversed just shy of that 36, 32 support on that last divergent low. But the fact that we almost got there leads me to believe that was close enough, and we'll probably go on and break it if this plays out. Again, you're looking at the size of this wedge, the measured target for a rising wedge pattern. You take the widest part of the wedge and you add that to where the wedge breaks down, and that would probably bring us down somewhere around that 35, 32 level if this plays out. So that's it. And so therefore, do the math, subtract from where we're at now, 39.05. Down there again, if that's what you're targeting, and then you can come up with a stop. Usually I like to use about a 3-to-1 risk reward ratio, meaning I'll risk $1 of loss for $3 of profit. So you got to apply the numbers there. Okay, and since I was on the 60-minute chart of ES, the S&P 500 futures, I'll just round out NASDAQ 100 and small caps. Here's a comparable trend line right here, a similar uptrend line as we have on some, I think it's on IWM. I'll show you that in a second. And also divergence that's been building for a while now. And, as I pointed out, it's just a wash, rinse, repeat thing. You can see all the way to the left of the screen here, divergent high, correction. Divergent high, correction, divergent low, next leg up, divergent high, little correction, divergent low, next leg up. That was the last correction on the break of this trend line, put in that small divergent low right above support, and that was the catalyst, the technical catalyst for this leg up. Now we have an even larger divergent high right now, and so therefore that sets the stage, I believe. Should we get rejections on that S&P 500 chart? Those charts I just showed you, rejection on the back test of the trend lines. Let's just say at this point in time, minimum target, swing target, 12,676. And if you're, an Uber bull looking for dips to buy, one thing I can tell you is I can't always get the call in the direction right. I do my best to do that, but what I'm pretty good at doing is identifying key levels. I'm going to show you. I'll do a quick update to the GameStop short trade and show you how those levels that I highlighted a couple of weeks, week or so ago, have played out almost perfectly with that stock so far, coming down, getting close to my final pullback target. RTY, these are the small cap futures. It's been small caps to the moon lately, but this is a nice clean up trend line here. I'm tracking on the 60-minute chart. You can see same thing. Wash, rinse, repeat. Divergent high. Look for your sell signal on a trend line break. It's not, you don't just short a divergent high because it can continue to diverge. You look for a trend line break like this minor trend line right here. There is your sell signal, divergent high, trend line break, sell signal. Divergent low, said, hey, look to get ready to cover shorts, look to go long for a rally, and that was the catalyst for the next leg up. Divergent high right here. There's your negative divergence lines down below, and that was a catalyst for that correction, which ended with you got it, divergent low. And that was this rally here. Now, so what we don't have, and look, you don't have to have divergence to bottom. You don't have to have divergence to top. It just certainly helps to support that case. And again, most importantly, you need that sell signal. So here's the trend line. Keep it very simple. There's a trend line on RTY. If and when broken, will trigger the next sell signal. There's divergence. Now, look, we technically have divergence right now. I've just showed you a scenario. I'm drawing out a scenario here where we could push a little higher, but we could stop right here because technically speaking, you have negative divergence. Prices have just made a marginal new high. Hard to see on this 60-minute chart. I know when you're watching the video, to zoom in real tight and then maybe you can see it a little better. So there it is. There's your divergence, and these indicators are lagging behind. So that is negative divergence. But again, divergence can continue to build. It in itself is not a sell signal, merely an indication that the next trend reversal is coming soon. Okay, and as I know a lot of you out there don't trade futures, here's IWM. This is our primary trend line. We're way above it right now. And I have this secondary trend line right here, divergence building. This is the daily time frame. IWM is becoming very overbought. Well, we know a correction is coming. It's a matter of when, and that's where we zoom down to those 60-minute trend line. Right here, what I'm doing on this daily chart is showing you the same. This is a comparable trend line to what I just showed you on RTY, the 60-minute futures. So that's our small trend line. That break of that brings us down probably to this larger trend line, and then if and when that goes down to the primary trend line there. So that's it. Same story. No sell signal at this time. Nor can I make an objective case to short. See, I can make the objective case to short on SPY, even though there's not a sell signal because there's a back test of resistance. On QQQ, we had that whipsaw signal I talked about a week or so ago, but it came and it was questionable when it came because it was right in front of Alphabet and Amazon's earnings. Proved to be a whipsaw because Alphabet was up strong after earnings and has brought QQQ back up. So on the daily time frame, we still need to see a break of this trend line for a sell signal on the daily chart. Okay, probably spent more time than I wanted to on the indexes, but I know a lot of people, are following those, tracking those. We're in a strong uptrend, but those are, at this point in time, there's no buy signals. You're at a high, and there's no resistance level that to look to break or any type of bullish continuation pattern. So all you can do, at least at this point in time, if you're long, stay long and look for that sell signal to get out. And if you're looking to short a pullback or even buy a dip, again, the levels that I gave you that are downside potential targets for a pullback or on a short trade are also objective levels to go in long. Those are support levels. Now let's talk about interest rates real quick. We're going to look at Treasury bonds and then the federal funds rate. ZN. Okay, if you'll recall a few weeks back, I was highlighting these symmetrical triangle patterns, really harping on these on Treasury bonds, saying that they could break either way. My expectation was they were going to go up if we got a, and would get a sell signal in the market. But I said they're going to break either way because symmetrical triangle patterns are just that. Some people try to loop them in as continuation patterns. I say quite often they're indecision patterns and they can break either way. And so this broke to the downside, and that was the biggest drop we had in treasuries in a long time. And it coincided with another thrust up in the stock market. Stock market was already in an uptrend, but the fact that treasuries broke down is net bullish for stocks. And so we had that sharp sell-off. This is again ZN. You might not be able to see the whole thing here. Let me center this. I don't know why that chart got out of whack there. There we go. ZN. When you're looking at the futures charts, you'll usually see the symbol up here, and I think also you can see it down here on the bottom. ZN is a 10-year Treasury bond future. So there it is. Breakdown. That ended, was highlighted recently. We had bullish divergence. That bullish divergence has certainly played out for a nice kickback rally right into that 137.202 level. That level was there in advance. The last update I did on this, we hit it perfectly, and you can see we also came in very close to that downtrend line right there if I extend that other on the triangle. So we pulled back, and now you can see we just broke out. So if this breakout holds, and we had positive divergence as well, so if this breakout holds, we're most likely looking at another run back up to that trend line or that 137 level, possibly more. And so keep an eye on this, because if we do get a rejection on the S&P 500 futures, as I started out, the video earlier, and we start to move lower, then you'll probably see treasuries begin to rally as a flight to safety bid. This is usually where institutions flock to when they're concerned or nervous about their stock holdings. So something to watch. And again, in the charts, this is bullish, the divergent low and the breakout. The breakout's not impulsive, at least not at this time. So put a little question mark by it at this point in time. But the fact we have the divergence, I thought I'd mention it for what it is. It is a breakout. And let's look at ZB. Remember, that's the 10-year bond. ZB is the 30-year bond. And the 30-year bond has been telling us what I've been saying and what I think a lot of others have been dropping. Remember, when bond prices, that's what we're looking at here. When we're looking at bond futures, we're not looking at the yields. We're looking at the actual price of the bonds. And bond prices and yields move inversely. When one goes up, the other goes down. It's very simple. And that's not an on-off relationship. I talk about how the stock market can be correlated to the dollar, the euro, crude oil can, and gold, even treasury bonds, but then at time they become disconnected. In other words, those relationships aren't always, exactly inverse or positively correlated. However, there is absolutely no deviation between interest rates and bond prices. They are directly inversely correlated. That's how that works. And there's a primary downtrend line on ZB. Again, 30-year Treasury bond futures. There's that triangle pattern I pointed out back then. And there was the breakdown. That was impulsive. That's what you want to see on a breakdown to confirm it. Just nothing but red sticks all the way down until we put in a divergent low right there. We got oversold, put in a divergent low. That was a catalyst for this reversal. We had a little uptrend line going here. Then we put in a small divergent high right there. You can see it. That was a catalyst for the reversal. And now this same divergent low we had back here has simply been extended. It's now much larger from the same point. It started at the same point right there. And there it is. ZB, the 30-year bond, broke out also above this trend line, just like the 10-year did. So that puts the near-term outlook for bonds as bullish. And again, that would not always, because it's been an on-off relationship, but typically that will coincide with a rally in the market. Here, I can show you this. Let's try to do this. Let's compare to an index, compare it to the S&P 500, and apply that, and then you can see what I'm talking about here. This is in green now, the S&P 500. One goes up, the other goes down. Typically, the one goes up, the other goes down. But there are periods where they can move together at the same time, but usually, as you can see, bonds are falling. It kind of squished down the bond prices when I put the S&P up here. But you can see that inverse relationship. And there's most recently the S&P rallying, right when bonds broke down from that triangle and had that big thrust down, inversely correlated. So therefore, if bonds were to rally back up to this trend line, that would most likely, not guaranteed, because again, I've done this many times, the relationship between bonds and stock markets, although it is typically inversely correlated, there are times where that correlation flips over to positive or no correlation at all. So I just want to throw that out there. But all in all, again, it's all about probabilities, and the probabilities or the odds are that if we do rally here, that's most likely going to coincide with a pullback or at least weakness in stocks. Now we'll look at the ETFs. This is TLT, the long, same thing, 20 plus year bonds, just like the ZB futures. You have positive divergence here on the daily chart. I didn't draw it too well there. Positive divergence on both the RSI and the PPO down below. And this was that same triangle right here, as I showed it on TLT back then. The yellow lines, which I've now colored over in blue, and that's where that triangle broke to the downside. You don't see any candles. There was a gap down because remember, TLT is an ETF. It only trades from 9:30, or at least on the chart you're looking at on the daily chart. It's not going to show pre-market trades or after hours. So you're looking at the regular session trades. So the futures were moving down overnight, and that's why you had the gap down there. So that was that big drop after the triangle broke to the downside. But again, now we have positive divergence for the first time in quite some time in Treasury bonds. And so that would, at this point in time, puts me as near term to even intermediate term bullish on Treasuries. And what that would mean is TLT bond prices going up and long-term rates falling. And please don't confuse long-term rates with short-term rates. Long-term rates falling typically means the market is expecting less inflation and less economic growth down the road in 20, 25, 30-year bonds. And here's what it looks like on IEF. Okay, IEF, same story. You have almost an equal low there, very close. If you make a little bit marginal new low, you'll have it. And you have these indicators clearly moving higher. So you have that positive divergence. There's a comparable trend line right there. I had, back at the time, I don't know where it went, but I had the triangle line there on IEF too, and that's where it broke down. So that's what we're looking at here. Looking at most likely a kickback rally, an abatement in long-term yields, a drop there, rally in prices, bond prices, and that can come in one of two ways. Again, it can come with expectations of lower inflation longer out, but it could also come with stock market jitterness, a correction in the stock market, whereas investors and institutions flock to Treasury bonds for safety. Okay, here's what I wanted to talk about on short-term rates. Remember, we're looking at 10 and 20 and 30-year Treasury bonds. That's what the market's expecting to happen many years from now. They're pricing in, again, those long-term bonds. The short-term rates, and those long-term bonds, by the way, they can be to a greater or lesser extent manipulated by the Fed and the central banks at time, but not completely. That's all supply and demand. The Fed, as big as they are, as much money as they can print, as much buying power as they have, they can't control or counter complete, all the money in the world. Remember, there's a lot of other countries that own U.S. Treasury bonds, and if they're dumping or buying, that's going to put a lot of pressure there. So I just want to make that clear that the Fed has never been able to, nor will ever be able to fix rates. Those are determined by supply and demand forces on long-term bonds. What they do fix and set is the short-term rate, the federal funds rate, and the discount rate. And those are pretty much overnight. It's shortest of short-term rates. These are typically for overnight loans to banks, financial institutions. They can borrow from the Fed or each other. And that's the rate you always hear about with the Fed, what they're going to hike or lower rates. And it's plain and simply, let me change my tool color here. This is what you're looking at. And you can go here. This is under the website is cmegroup.com. Just do a Google search for Fed Funds countdown or rate watch, Fed Funds watch, and it'll bring you to this window here. Or this page. And what they're showing you up top, these tabs show you the upcoming FOMC meetings. You can click on these. I'll do that in a second. And down here it will tell you what the target rate, what the Fed funds rate, the probabilities are. And you can't see it probably on the video, but that says 100% right there. There's the scaling. So this is the next meeting coming up on March 17th. There is a 100% chance, not 99.9, 100% chance that the Fed funds rate will be between 0 to 25 basis points where it is now. In other words, that's saying no change. That's here. You can see that's where it is now, and that's where the probability is. So then you go down the line, and then you go to the April 28th meeting, and you can see there's a 2.2% chance that the rate would go up a quarter point, between 25 to 50 basis points. And you can go down the line. I'll do that. I can click on all these, but you're going to see the same thing. I've already done this. The rates are, if I go all the way out here to December, the last meeting of the year, it's still at a 2.1% chance, almost no chance of a quarter point rate hike. So I think this is a potential trade idea. I've never bought Fed funds futures before. I've done all kinds of futures, and I just did yesterday. I started a position in ZQ, which I can layer into or add to. Never traded them before, but the way they work is like this. Basically you're betting on where the Fed funds rates are going to go, and their price, those futures, the ZQ. Here, let me pull up a thing here. Here it is. Let's zoom in a little bit for you, and you can maybe make this out on the video. Here's how they work, if for those of you interested. They trade in, don't worry about that contract size. You have to put up very little money. It hardly burns up any margin in your account. I think one contract, I don't know how that works. It's showing me, where is it, about 416,000 position size. But here's the thing. They're very low volatility on those, as long unless rates did something crazy. Here's how they trade. Each contract trades in 1 quarter on when they get to the near month contract. The next one, a quarter of 1 basis point. So 1/4 of 1%. And that's $10. Every move there represents a change in each contract of only $10.42. But then all other contracts out. Like I went with the December contract. It's liquidity's not there. Usually most traders will go with the near month contracts because there's more volume and liquidity. But these things are priced pretty firm. And the way they work is they basically take the number 100 minus the here, let me do that for you. Number 100 minus the Fed funds rate, and that gives you the value of the contract. So if the Fed funds rate is, let's say, at 5%, even though we're not even near that right now, then these futures be priced at 95, right? And therefore, if you were betting that rates were going to go up, let's say from 5 to 10%, you would actually go short. So that's what I am. I'm short the Fed funds futures, betting that rates are going to go up, because now if they go from 5% to 10%, then the futures would be worth 90. That's where they'd be priced. So I'd cover that. I would have shorted at 95 and bought to cover at 90 again. And so now we're looking at much smaller moves. I'm only looking at a quarter point move, and I did the math for you on a quarter point move, because they represent every, as it says right here, 1/2 of 1 basis point, or a 0.005% increase in rates equals $20.83.5 per contract, which double that number gives you $41.67 per basis point. I hope you're tracking. I know I'm probably some people are probably glazing over here. Let me put it to you this way: if by December, and that's a long way out, we get a quarter point hike, or actually we don't even have to have a quarter point hike. All we have to do is get the expectation. This is what the probabilities are. And so if there's that expectation anytime between now and December, and the odds favor a quarter point rate hike, even if it hasn't happened yet, that's when those futures are going to price it in, again, if it's favored. And so a quarter point increase in rates by December, again, all other things being equal, it needs to be priced in the futures, not necessarily what the Fed does, but what the futures traders think they will do, would equal $1,041.75. Again, that's a 0.25% increase in the federal funds rate by December. So just wanted to pass that along as a trade idea, and then reiterate once again, this is what we're watching for tomorrow. And look, maybe CPI comes in cool tomorrow, but if you get a hot CPI, meaning above expectations, then that could and most likely will change that those Fed fund expectations. And then Powell's going to speak at 2 p.m. after. Best I could tell yesterday, I did a search, Loretta Meister spoke, and she's uber dovish, saying pretty much, zero rates forever. Fed's going to keep low for as long as, for the foreseeable future, for a long time. Bullard speaking today, right now actually. Who knows? We'll see what he says. And again, this is what we're going to watch. Now, whatever they say, I imagine that he already has advanced knowledge of the CPI, my guess. And what we're looking at here is a consensus on the CPI. Month over month is an increase of 0.3%. There's your consensus range. All this again is available on this economic calendar, is available on under tools of the trade, on right side of the chart. Click on the resources tab and you'll get the economic calendar, and there's your, so that's what we're looking for. We already know, I've gone over this ad nauseum lately, food and energy prices have been skyrocketing, and that is very now they're going to, they look at the core CPI, they back that out because those are volatile, they tend to move up and down more month to month, but again, they are components of the CPI, and they're the largest components. That's what's going to impact the CPI more than just about anything else. Okay, so then on a related note, we'll talk about that. This is crude oil, huge move off the bottom. I don't consider this inflationary. You might say, Randy, that's crazy. That's a ginormous move. It's, hundreds of percent. No, that just was a reinflation trade. Energy, crude prices collapsed, and they collapsed more so than other things, just due to the technical nature of crude futures. You can't. Crude has to be stored somewhere, and it had to do with storage issues. And so, remember, prices collapsed. They actually went negative. That's not reflected on this chart. I guess that was intraday. This is end-of-day prices, I'm assuming here. But what I'm trying to say, we just got back to where we were, but now we're above pre-pandemic levels at this point in time. So you can say, in a sense, this was, but this is inflationary. The fact we've been trending higher, very strong trend, clearly inflationary. And you look at other things, lumber, I mentioned lumber, it is on my radar. I haven't updated in a while. This will be a monster short coming up, but it's also very inflationary. And this is one of the biggest costs to home construction prices. We know home prices have been going up very strong lately, even before COVID and after COVID. And I've shared this chart before. What you look at, lumber tends to move up in these parabolic runs. You have a strong uptrend, and then it eventually goes parabolic. Parabolic advances do not end well. This one was I have it measured out. You could probably make it out in the middle. This was a 53, almost 54% drop. There was another mini parabolic run, 36% drop. There was a regular uptrend line, but once it was broke, there was a divergent high, and a lot of these end with divergence. 42% drop. We then entered a parabolic run here earlier in 2020 with a 45% crash in lumber prices, and once again another parabolic run. And this time around we have negative divergence. We did not have divergence on this one. We still got a 45% drop. This, we have a big divergent high, and I think therefore, I think there's probably going to be better than at least a 50%, give or take, drop coming up in lumber prices. We just need to get a sell signal there. So again, the two takeaways from this is number one, a potential trade idea, a setup, not to be confused. I said all the time, there's a difference between a trade setup and an actionable trade idea. It's a trade setup. And the other thing is to just kind of reinforce that I don't know where they're coming up with these CPI numbers, because inflation is here. It is clearly in just about every, in all these commodity prices. It's in asset prices, and I don't think the stock market's not part of the CPI, but that's an asset bubble, and it is inflationary. So we watch and wait. And, these things can take long time to pan out. So I'm just going to watch these CPI numbers as they come out. I'll listen to what the Fed governor, Fed members have to say. And like I said, it'll be a slow walking down. The Fed will not go from uber dovish to uber bullish on the turn of a dime. They will gradually and very subtly try to walk things down once they realize that all this Powell's been saying all along, he doesn't see inflation as posing any type of risk to their zero interest rate policy. And I disagree. Okay, so where will that sell signal come from on lumber? Tough, because I don't have a great trend. I had one here that was broken, but it was a minor trend line, not very well defined. I have even a smaller minor trend line, but we're wedging up now. We have divergence on the RSI. By the way, this is a 6-month chart with 2-hour candlesticks, 2-hour bars. There's your divergence, and it's actually steepening at this point. It's dropping off, getting a little more pronounced. There's the divergence on the PPO down here, RSI divergence, and so it could be a break of this minor trend line. Remember, you're not seeing a parabolic move here because I'm zoomed in on a shorter time frame. On that daily chart I showed you, the move is parabolic, and so gosh, targets on this, well, I'll if and when that time comes, I'll give you targets, but at minimum, look for that reaction low to be hit. But again, based on the big divergence on the daily chart, we're going a lot lower. I'll probably have to zoom back out to the daily chart to come up with targets on LB lumber futures. And before you ask, to the best of my knowledge, there has never been, and I don't believe is, a ETF or ETN that directly tracks lumber prices. You have Wood and Cut, but they track forestry and timber companies that produce lumber and products like that. But these are actual random length lumber futures. So you'd have to a direct play is a futures, and indirect play would be those two ETFs, Cut or Wood. Okay, in the beginning of the video I said I'd update GME just to highlight these levels. This is GME, GameStop. This is that 5-minute chart. This is, it went parabolic. It was in the news. Here was the first 5-minute chart I posted on the site. It was on, where is this? This is the 27th of January. Said we'd need to break this trend line to get a sell signal. There was no sell signal at time, so there's a good example of a setup versus an actionable trade, because if you shorted here without a sell signal, well, guess what? That sucker went up to 500 or something like that. In the next update, there it was. Then that was the trend line. Sell signal was triggered there. And so just note, again, this is January 28th, the day after that. Just note the levels here, 250, 147, 86, 65, 62, 56, 50, 45, and ultimately 35.70. Those were the pullback targets. I didn't have enough room to show the arrows going all the way down here. And so here's the current 5-minute chart without those levels being edited or modified. So there was this was it, the sell signal back here, right there. And then we went on to go down. We backfilled the gap. There was what I call momentum fueled overshoot. That was a straight drop, and that drop alone was 61%. And so you had what I call momentum fueled overshoot. To be expected when you have a near vertical plunge. You're going to overshoot a level, snap back above it, went back to the top of the gap. It was a lot of volatility, so you had some momentum overshoots, but you could see it danced around and held that 250, because I was highlighting that because that was a gap. And once we clearly entered the gap, boom, gap down to the bottom of the gap, actually below it, took out the bottom of the gap, which was that 147 level I had, hit the next target, bounced, You could have micro traded this, covered, reshorted if you could have got it. It was a mess because half the time there were no shares shortable. They kept putting trading halts on it. But I just wanted to point out what I said earlier. It's identifying these levels, and then you trade off them as you see fit. If you were bullish, you would have bought there, and if you were bearish, you would have shorted there or waited. You could see it did prove to be support. We hit it, bounce, and then boom. What happens when we broke it? Well, we went to the next target. What happened when we got to my next target? We consolidated. What happened when we broke the next target after the consolidation? We went to the next target. So forth and so on. A little brief dip below, but then shot back up. That was capped at that 86 level. Again, that was a brief, these are 5-minute bars, spiked above it. And again, I just want to point out how it's been dancing on same levels on those charts posted, a few weeks back. And that's it. So finally, we danced on my 56.50 target, and we took it out. Once we took it out, we went right down to the next one, and that's where we're at. So now, I wouldn't touch this one with a 10-foot pole here. Most of the meat has been milked on the short. Since that sell signal right there, it popped up a little bit, got a little underwater if you would have just tucked it away, but so far you'd be, it's an 85% drop in the stock. So you would have, you shorted 10 grand, you could cover right now for $1,500, and put all that profit in your pocket, $8,500. Okay, long video, and we're going to just end it here because somebody asked for an update on Bitcoin. I said in the comment section in that reply to that question, I don't have much of a read on it right now. What's moving Bitcoin? There was a trend line break right here. There was a divergent low at this point. So that was a technical catalyst, and there was some news-driven things. The big thing the other day was Tesla announced. I'm going from memory. I think they said they purchased 1.5 billion in Bitcoin and would start accepting Bitcoin for the purchase of its products, its cars and whatnot. Look, I didn't look into that story. I have two things on two thoughts that come to mind. Number one is, to me, that's borderline front running. Now, I used to be a stockbroker. And what front running is I couldn't advise my client buy XYZ stock if I bought it right before them, because what you can do is you buy XYZ, call all your clients, especially you got people with a lot of money, and then tell them buy XYZ, and that runs a stock up. That's front running. That's very illegal, at least for a broker. Now, I know Elon Musk is not a broker, but he's been in trouble with the SEC before for tweeting out non-public information, positive earning results coming up, things like that, and he got slapped on the wrist pretty hard for that. So anyway, I the fact they take a $1.5 billion stake and then announce that they're going to start accepting it, again, I don't know if the SEC is going to look at that or if that's okay. The other thing is, Tesla, of course, last couple quarters have been good. They're selling more cars. They met some targets, but not so long ago, all we heard about is the cash burn rate, how low they were on cash, how precarious, the company, what a precarious situation they were in. I think if they have a $1.5 billion stake they took in Bitcoin, we all know what Bitcoin, when it rallies, it runs like nobody's business. And when the tide changes and it drops, it crashes. That's the history of Bitcoin. That's what it's always been. I think that's what it'll always be. And I think it's gross negligence for a company to put they're selling cars. And so I think the company's at risk if Bitcoin were to crash anytime soon, and they're holding a stake of, let's say, 1.5 billion or whatever their number is. I think that's negligence of the board to allow that kind of thing. They're a car company. Why are they speculating in not even the stock market, in almost an unregulated security? So Bitcoin crash, the company loses that money. Oof, I don't know. That's just my thoughts. So you know me. I'm just watching, waiting patiently for Tesla to break that big 800 level, and with some other confirmation in the stock market, and then I think that'll be a nice swing short with a lot of downside potential. And it's the charts that tell me as well as anything else. Okay, so forget about my fundamental ramblings on Tesla, whether any of that matters or if I might be completely off base there. Trend line, that's what you want to watch. That trend line's pullback target. If you get it, if you're bullish, you buy pullbacks to the trend line. If you're bearish, you want to wait for break of the trend line. I updated, I had covered Bitcoin a while back here as a potential short idea, but I said at the time, somebody said something about the Bitcoin trade not panning out, and that's never been. I don't care to trade GBTC. My proxy at the time I stated was Riot. So Bitcoin broke down and had a big drop. It dropped 32%. Riot was my preferred shorting proxy, and that was a break right there of this trend line. It went on to trigger sell signal shortly after highlighting it, and it dropped about 27%, but reversed just shy of that 1553 target. And of course, it's correlated. I call it a Bitcoin proxy because it tends to trade in line with Bitcoin, and it's Riot Blockchain is the name of the company. And Bitcoin rallied, so this has rallied. Now, what it's doing is heading up for a back test of that trend line if I extend it right there. So that would mesh with a breakdown in Bitcoin and look big divergence unless it keeps going up, and that's possible. I don't have a strong opinion on Bitcoin. I'm just covering it because I've been asked to. I gave you the trend lines, the levels to watch, but if this one reverses soon, there's a potential short. We may come down and fully hit that 1553 target. That would be my expectation, and possibly the next target there at 1118 on Riot. All right, that's it. Long video. I had meant to update that crude oil chart. I posted this morning. Breakdown in crude, little snapback rally. We're still below the trend line. Maybe we go to back test. Maybe it just proves to be a whipsaw signal, but it is a clean looking breakdown to me. And if that pans out, then I give you my targets. Again, that was posted on a static chart, a chart image on the front page, so you can look at those targets. The way it works, by the way, this is a minimum target, and we may just hit that and reverse, and that's it. If that level breaks, if we get more confirmation, if we start moving lower and the charts confirm, then I'll do an update and tell you if I think that'll level hold or not. But as of now, let's just call that the minimum and first and only pullback target at this time. We'll again, the breakout may not even stick. If we get back above the trend line by a fair margin, the breakout's failed. As of now, it's intact. I just wanted to point that out. All right, let me wrap it up here, get the video out to you guys. It's been a long one, but I wanted to wrap a lot in there, and I'll do my best to catch up to questions and on the homepage and the trading room, get back to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.